Hi guys. Today we will analyze Gap stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The short-term trend is negative, the long-term trend is negative. There should be more interesting stocks out there. Support level is around $15. Be careful, there is not too much support below $15. Resistance level is around $19.70. The next resistance level is around $22. In the last month the stock has been trading between $15.50 and $18.50. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 9 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 2% per year, for last 5 years. We see that the average profit margin of the stock has been around 2% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 54% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Gap Company: bad, average, and good. First scenario. Gap will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 2%. Future free cash flow to net income rate would be low, 40%. In this case, the fair value of the stock today would be $6. The second scenario. Gap will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 4%. Future free cash flow to net income rate would be average, 60%. In this case, the fair value of the stock today would be $17. The third scenario. Gap will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 6%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $35. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 1.32. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Gap, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 12. Again, I will use 3 different scenarios for Gap Company: bad, average, and good. First scenario. Gap will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 10. In this case, the fair value of the stock today would be $6. Second scenario. Gap will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future P/E would be average, 14. In this case, the fair value of the stock today would be $9. Third scenario. Gap will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 18. In this case, the fair value of the stock today would be $14. As you can see, today the stock is overvalued, $16, even if we expect the company's high performance in future. Both the profitability and the financial health of Gap are neutral. Nothing too spectacular is happening here. The stock's current low valuation adequately reflects the company's near-term challenges. I may consider buying the stock if it drops below $14. I like its dividend, 3.47%. Company's strengths. Gap is a specialty retailer of clothing, accessories and personal care products for adults, teens and children. The company has 4 brands: Gap, Banana Republic, Athleta, and Old Navy. Gap operates approximately 3,100 stores and over 600 franchise stores in more than 40 countries. Old Navy is the largest apparel brand in U.S. It competes in the discount apparel sector, which has been healthier than other areas of apparel retail. Athleta has established itself in the fast-growing women's athleisure market, one of the bright spots in North America apparel. The number of Athleta stores may double over the next decade. Gap recently addressed the impact of Chinese tariffs by shifting some sourcing to suppliers outside of China. Gap has a yearly dividend yield of 3.47%, it's higher than the industry average. The company pays out 30% of its income as dividend. This is a sustainable payout ratio. Risks. Gap has faced pandemic-related supply chain challenges and rising input costs. It will take Gap several quarters to complete a turnaround and work through current supply chain disruptions. The company was also recently hurt by extended plant closures in Vietnam, where 30% its products are manufactured. The company's near-term growth prospects depend primarily on Old Navy and the fast-growing, but smaller Athleta brand. Both Gap and Banana Republic have been hurt by mall closures in the U.S., as well as by reduced foot traffic at most locations. The company's greatest challenge will be increasing store traffic and changing consumers' perceptions about the quality and affordability of products at Gap, Banana Republic, and Old Navy. Gap also faces strong competition from other specialty retailers, department stores, discount stores, and catalogs. The stock's current low valuation adequately reflects the company's near-term challenges. Gap's return on assets of 4% is worse than the rest of the industry. Gap has a return on equity of 18%. This is below the industry average. Gap is expected to show a small growth in revenue. In the coming 5 years, the revenue will grow by 6% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.